Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. First, I'm going to start off with a question that somebody has, just so everybody understands what's going on here. So I'll start with the question, and then I'll kind of give you my opinion behind it. It says, I'm a novice, so I thought decoupling means inverse. What I meant was inversely correlated, or when something moves down, the other asset moves up. That's inversely correlated. And it says maybe it means independent of, like its movement does not relate to the other asset. Can you explain? So what we were talking about is uranium in relationship to the overall stock market. And there are periods of time where things couple up. And what that means is that the movements of the stock market and uranium market move in tandem together. And the more correlated they are, then their natural traits tend to come out with every movement of the stock market. So uranium is a very small sector. It is highly volatile. And if you had a highly coupled market, what we would have seen in a highly coupled market where uranium has a high correlation to the stock market is when the stock market went down 5 or 6% like we saw on 9/13, well, we would have seen uranium go down like 10, 15% if they were highly correlated. And uranium was doing basically what the uranium sector does, which is an amplified move. Well, I should say it's a very volatile sector. So what we saw was we are seeing a decoupling of uranium. And what that means is that the influence of the S&P 500 over uranium has decoupled quite a bit. What that means is that we saw a 6% down day in the overall markets, in the NASDAQ especially. That's really the one I'm looking at, is the NASDAQ. We saw a 6% down day in the NASDAQ, and uranium didn't go anywhere near down 6%. If they were coupled up, and if uranium had the traits that it has, we would have seen a 12% down day or something, or more. We should have seen a blowout crash in uranium, but we didn't. We didn't see a blowout crash in uranium. So what that means is that we're seeing relative strength, and the market did not couple up to uranium at that time. And we've been seeing a decoupling between uranium and the overall markets, which means that the overall markets are having less of an influence over the uranium sector than what it had before. Because we saw markets where they were really coupled up. The S&P fell 3% and uranium would have some blowout day, like 8 or 10% down day. So we are seeing a decoupling, which means that there's less of an influence between these two assets. They are breaking apart, the influence of it. It doesn't mean that they're inversely correlated, where the stock market sells off massively and uranium is just completely unscathed. Now, we can see that, but that's not exactly one of my expectations. Usually when the market has some blowout, sell everything type of event, that uranium would also be impacted, oil would be impacted, all these other commodities very well could be impacted. They may not, they may or may not be. What we're playing with as investors is we're not playing direct correlations. We're not playing the relationships between all of these assets. They're not all 100% directly correlated. You won't see the S&P 500 fall and something else necessarily go up. You won't even see yields, which has a strong correlation, inversely correlated, where yield prices go up dramatically. You may or may not see the S&P 500 fall. It all depends. They are loosely correlated. So we're seeing all these assets that are loosely correlated. What does loosely correlated mean? It means that if something moves in a certain direction, and it could be either correlated or inversely correlated, the other asset, so if this goes up and this is correlated for it to go up, it doesn't mean that 100% of the time that this will go up. It means that, let's just say they're correlated by 50%, that 50% of the time when this goes up, this also goes up. So we're playing with all these loosely correlated assets, especially in the short term. They're very loose, but in the long term, their correlations jive much greater, which means that if you were to take a month, a candlestick that's a month in duration, that their correlations are pretty high. And one is usually has a higher, I can't remember if it was something, you can put this in the comment section, one that has greater volatility. I can't remember if it's like alpha, has greater alpha, I believe, than the other one, if I can remember it right. I always look at statistical type stuff. I can't remember all the names that they have for the stocks, but we're playing with these loosely correlated things, and since they're loosely correlated, you're going to see disconnects in the markets actually quite frequently. But we're looking for the general trends. We're looking for those things that are that uranium is strengthening and oil strengthening on a blowout down day like that. Here's another thing that I want to make a comment on. If we were going to have this deflationary blowout crash that some people are calling for, we should be seeing interest rates fall. We should be seeing interest rates fall. And what that's doing is we should be seeing the banks pile into bonds. But we're not seeing that. We're not seeing that. We're seeing yields go up and bond prices fall. They're running away from bonds, not to bonds. That means the banks are afraid of bonds. They're selling them. And if we were going to have a deflationary crash, which they would know of because deflation means you've got a destruction of credit. They're the ones that create all the credit. And if they don't see any destruction of credit and they're running away from bonds, they must know that there's a problem. Inflationary problem. Or a problem in the bond market. Because if credit was going to be destroyed, they'd run into it. Just like they did in all the other crashes. They ran into bonds first, and you could see the yields drop before the crash came. You can see it before the 2020 medical event crash. You could see it in 2018. It was 2018 all the way to 2020. It was falling, and then it really fell out towards the bottom of 2020. You could also see it in 2007. Yields were starting to decline because credit was being destroyed and they were loaning a lot less. The combination of those two things. Now, I was looking at a bunch of different assets, and we'll look at it here together. So I'm going to shut this one down, and we're going to look at some assets together. It's busy here. Don't worry. I'll describe it all. Don't worry. So what I have here is the TNX divided by TYX. And that is your 10-year yield divided by your 30-year yield. And if you're to kind of take like a big picture view, what we've seen a stabilization of this yield. And then right at about 1990, we're seeing a more dramatic kind of movement in yields where it goes up and down. We've got these big cycles that are happening between the differences or the spread between the TNX and TYX. And what I did is I said, okay, what happens when the spread here? So what this means is that TNX is underperforming TYX. So TYX is getting, basically the curve is becoming more normal. The curve is flattening out. The curve is becoming more normal. The curve is flattening out. And when the 10-year yield goes up at a faster pace than TYX, it goes up this way. And certain assets behave differently under these, under the spread between the two, whether the spread is increasing or if the spread is decreasing. And if the spread's decreasing, and I'll kind of just tell you what these assets are. This one is gold. This is gold in the middle here. The blue or greenish color is crude oil. This here is the United States housing starts. And this is the starts, and I put the average. This white line's the average going into it. And then on the bottom, I've got the Huey, which is basically gold and silver mining stocks. And what I wanted to see in this is how correlated are some of these assets, or how inversely correlated are they, where when this spread gains, what goes up, and when this spread tightens, what assets go up, and is there a correlation here between money coming into the system from the housing starts and money being destroyed or coming away or slowing down? And I think there is a correlation here. And we've got crude oil, which is highly sensitive to this movement, and so is gold, but in a different location of the way that this spread operates. So let me describe what does well and what doesn't do well. So if I kind of zoom in here, when this spread basically goes from a flattening to a normalization, when it goes down, gold loves this type of environment. Basically, it's from the green line to the white line. So this is the top of the yield. And then as that basically goes from a flat yield curve, or when the 10 years flat to the TYX, when they equal each other, and then we get a spread between them and get a big spread, gold loves that. It goes ballistic. And under that type of environment, at least from 2005 to 2012, 2011, in that type of environment, gold went up 235%, and the Huey only went up 81%. The Huey still outperformed, but it didn't like that environment as much as gold for that stint there. That was with the housing starts declining. So the housing starts were declining. We were getting that credit destruction. The yield curve was normalizing, where the short end was going down at a faster pace than the long end. So the 10-year yield was declining at a faster pace than TYX, and we had gold prices go up 235%. Gold loved that scenario. If we look back at the beginning of 2000 to 2003, and you look at the decline of the TNX to TYX. So what was happening here, and I think this is what's going on, I have to verify this, that the 10-year was underperforming TYX. The TYX was going up at a greater pace than TNX. I think that's what was going on in this decline here. Remember, they can both be going up and get a declining ratio, or they could both be going down. TNX, I think, is a short-term, more volatile movement. So and this is more anchored to a certain position. So if this is more anchored, TNX is actually doing the movement more so. And usually what happens is this is a movement going down, where TNX goes down at a faster pace than the 30-year yield, TYX. That also went up 39% for gold, and then the gold and silver mining companies went up 153%. That is with the housing starts being above the average and increasing in its output. So the way that I would view this, and we're looking at market conditions, what I'm trying to do is I'm trying to pinpoint what market conditions gold likes, what market conditions crude oil likes, and what market conditions gold and silver mining stocks. Gold and silver mining stocks historically are very picky about their market conditions. They don't really work in a gigantic amount of market conditions, but when they do work, they work very well. So I'm looking at these yields, and I'm trying to tie it to where the heck does these assets, where do they work? And how could we use this as an investment leading indicator? So what I found, though, is that when TNX underperforms TYX, when it goes down at a faster pace than the 30-year yield, gold loves that. Now, when we're above the housing starts, when the housing starts are increasing, we can see that when this is declining, gold and silver mining stocks do very well, kind of at the beginning of a bull market, the very beginnings. And when we saw it this past time, we saw a similar type of scenario happen in 2018 all the way to the bottom of 2020. We had a very similar scenario where the TNX to TYX ratio fell, where TNX, the 10-year was falling at a faster pace than the 30-year. Gold went up 68%. That's a very good return. And the Huey went up 160%, which is actually a pretty good return. So another thing I noticed is when the 10-year yield goes up against the 30-year, think of it as inflation. Think of it as oil increasing. When we got those scenarios, we always had an increasing, for the most part, we've always had an increasing housing starts. And we also had this increase in the 10-year going up faster than the 30-year. Oil, what oil really, really likes is when the 10-year yield and the 30-year yield are going up like this. Here, we go from a low level upward, and we've got the housing starts above average. That's when oil goes ballistic. It went up 451%, and granted, we came from an anomaly bottom there. The bottom was incredibly low for oil as we had massive problems with the shutdown of the economy. But the same one is when we went from a low to a high area for the 10-year yield outpacing the 30-year yield in an upward environment. Oil also went up 200% from 03 to 05. And then the yield kind of went flat there. But it was still considered compressing. So the oil price continued to go higher even though TYX kind of flatlined out. You could say that we could draw this further to the right, or you could kind of ended it where I had, but you could draw this all the way to where it started to decline again, which would be this area over here. And what we saw there is oil went up, but it didn't really go up that much. It kind of paused. It was or slightly higher during this period. And then it started to take off when the TNX to TYX basically flatlined or slightly started to decline. It didn't impact oil as much because this ratio was still going sideways. And we still had money coming and flooding into the system here, which is about an 18-month delay or so, 2-year delay. But we had this decline in this ratio, and that's when gold went ballistic. So looking at this data here, I think what we want to walk away with is we are looking for a particular setup in all of these assets. And the particular market conditions work very well under these conditions. So what I saw recently, and let's look forward here on what we could potentially project going forward here. So when we look at this, we've got this yield here we've got the 10-year moving up rapidly. It's going up at a faster pace than the 30-year. Whenever you see that type of scenario, usually that's positive for oil. Oil does very well under that scenario. Now, I don't know which one's leading. I don't know if the 10-year yield is leading the 30-year yield, and that oil, I think what's happening is oil is the cause of that move. It's oil outperforming everything else, which pushes the 10-year yield up at a faster pace than the 30-year yield. I still think that when they stop the Strategic Petroleum Reserve releases, that this yield will probably go higher and that oil will outperform. We had a slight decline from April of 2022 lower all the way downward. And we saw precious metals, they were starting to firm up, and I think that was people basically expecting that this yield here was going to fall, that the 10-year was going to fall faster than the TYX. I think everybody was pricing that in. We saw precious metals firm up. We saw uranium start to firm up. We saw a whole bunch of different things in the economy start to firm up. But now, since the 10-year yield shot up in relationship to the 30-year yield, I think it's going to be still go time for oil. It means that we're in an inflationary environment, that inflation is still out there. So if I were to make a guess of where the markets were going to go in the short term, again, this is not advice, it's not anything like that, it's just a guess. Based off of what I'm seeing, I think that when they stop the releases of the Strategic Petroleum Reserve, we're going to come into a deficit in oil, probably this winter. And if they stop the release, the markets are going to get absolutely tight. And if China comes back and they stop their lockdowns, we could see a 5% swing between demand and supply. A 5% swing. And I think we're going to see oil tighten up very much so. And if they try buying and restocking the Strategic Petroleum Reserve at any one of these points, I think oil is going to go way higher. And I think that's going to impact precious metals in a negative way in the short term. I think the TNX to TYX will go up. It'll get even more squeezed. And I think that I don't know what the housing starts are going to necessarily do. We'll have to watch that. And then we'll have to see what the Huey does. Remember, the Huey likes an increasing housing starts. It likes the decline of TNX to TYX. So what happened here was we went into a cycle where things were tightening on the front end, and then this is the curve basically uninverting or unflattening. So unflattening curve, and this is a flattening curve, where when that curve flattens, we're getting inflationary pressures in the short term. When it unwinds, that's when gold comes to life. And what's great here is we can get into gold, we can get into Huey here, and then do our swap basically August of 2020. That's basically where I swapped into oil and uranium, and then we've got this move higher here. And I still don't think this move is done. I think they're trying to delay the move with Strategic Petroleum Reserve releases. They started releasing it right when this started kind of coming back down, but they don't have oil forever. They're not a producer. They're just depleting their inventory. So I do think that this could potentially go higher. The one thing I will say, though, is this going is at a very low level compared to history. And it was always advantageous to be looking at precious metal stocks when the TNX to TYX is at this level where we're at today. So even though this could compress further and go higher, I think that precious metals are probably a spot to be looking at. And by looking at historical measurements and looking at history here, I would expect that the metals would do very strong and that the metals could outperform the Huey itself, where gold, physical gold, could outperform the Huey. And I could be wrong here, guys. I really could be wrong. We saw an outperformance of the Huey both times at the beginning of a bull market in commodities. The beginning of this bull market here from 2000 to 2003, and this from 2018 to 2020. Then we saw the cool off as this has gone on up. So, I think both assets, and since they're inversely correlated, basically, what you see as a sideways movement in gold, and you see the large up movement in oil. I'm kind of playing both of them. And I'm not 100% sure where this housing starts is going to end up. If the housing starts remain high and we come back up, and this is just a bounce off the average, much like 2000 hit, and then we started rallying again. If we rally again in housing starts, I think that oil is going to do very well because of the inflation in the system. Granted, we've got stimulus money in this time. And I think precious metals could do well as well if this TNX to TYX drops. Well, I'll say it, that the short-term inflationary pressures start to ease in the short term. So that's your market conditions. Hopefully you guys kind of got some information on this. So if I were to sum it up using narratives, if inflation is running rampant in the short term, oil is your bet. If things start to ease and the Federal Reserve starts to not raise interest rates anymore, if they become more like flattish to slightly lower, but basically flat, they're not raising the rates anymore, I think gold takes off. And that's when the curve starts to normalize. It means that things are slowing down in the markets. It means that we're going from the right-hand quadrant here and moving left to the first quadrant. in slowing of growth. I think that we are getting that, but we're looking for the slowing of inflation as well. So it's slowing of growth and inflation back down that precious metals do very well under. That's your environment of the mid 2000s to 2011. It was a slowing growth, slowing inflation, and that's when it really took off. So that is what's important to understand, is what market conditions do these assets work well under. So the way that I view this in a commodity bull market, if you were to play precious metals and oil, is precious metals works well in the beginning when interest rates have not responded to the inflation. TNX to TYX falls some because we went through a crash. We have a reflation. I would choose gold stocks at that time. I would rotate my gold stocks into oil and energy. Energy from that point on starts to go up. And where uranium did really well is when, and I'll show you kind of when that happened. It's when the this ratio here kind of flattened out, and that's when it went ballistic, is when it flattened out. And I think that's basically at the spot that we are right now. So the market conditions for, I think, uranium are ripe right now. They're ripe. I think they're ripe for all of these to do well in oil, uranium, and even precious metals. We could see one last maybe leg lower in precious metals, maybe this winter, depending on what this ratio does. I think people were kind of surprised by the release of an 8.3% inflation number. So we'll watch all this together, guys. If you guys need help, definitely sign up for the membership, the platinum membership on the website below. Subscribe to the channel if you haven't already subscribed, and we'll catch you next time. This is Finding Value.